Perfect. So, everybody, welcome. As you know, today is an important day. It's actually your best friend's 62nd birthday. This morning, you've got the balloons ready to go. You had flowers, breakfast, everything was ready. She steps off the elevator, walks down the hall, opens the door, and what does everybody yell? Surprise! And she walks right past you. You're all standing there stunned. She walks into the CEO's office, sits down at her desk, and says, I'm retiring and I'd like to start my pension. The CEO leans back. Are you aware that by starting your pension now, you're reducing it by 30%? I know. Did you know that by cleaning out, you're limiting your spouse's options? I know. Are you aware your pension is tax exempt in California and there may be additional federal advantages that you're giving up? I'm aware. She asks one more time. Are you sure? Her response, very. Ladies, how did she get there? How did she gain that clarity and confidence to answer those questions without hesitation? Because there are a lot of questions. How will she handle health insurance and retirement? What should they do with their rental properties? What's the most efficient way to gift to kids? Is it now or is it later? She's been working 40, 60 hours a week most of her career, helping her kids get started. Grandbabies are on the way. A couple of years ago, she settled her parents' estate, and all while trying to plan the next family vacation. There are a million moving pieces, and making the right choice, it's tough. There's no doubt about it. And ladies, y'all are all rock stars. You wouldn't be here tonight if you weren't. Who likes to spend a Wednesday night learning about Social Security outside of us? Y'all do. So thank you for being here. So, how did your friend do it? She didn't guess. She didn't wing it. She had help. She had a financial plan. And yes, she read our book too. But more importantly, she had a plan built around five key areas, a framework that gave her clarity, confidence, and control. And that's how she walked past the surprise party and into her next chapter. I'm Kenneth Hamilton. I'm one of the managing members of Mission Financial Planners. I'm joined by my partners, Jason Defoe and Mr. Matt Donaghue. And I want to talk about three things tonight: our why, my why, and how the five pillars of financial planning can truly change your life. We created Mission Financial Planners for people like you, motivated, thoughtful, driven people who want to make informed choices. Each of us had our own path into this industry, different backgrounds, different experiences, but collectively, me, Matt, and Jason, we kept seeing the same gaps. People working with advisors for years, but no clear Social Security strategy, tax strategy, estate plan, no real conversations about elder care for their parents, let alone a plan for themselves. Retirement accounts were invested, but where was the cohesive plan tying everything together? You, the client, needing to bring these topics up for discussion and not the other way around. Good people, good intentions, but knowing no one helping them think through this next and final chapter of life. And there are a lot of decisions to make. Now, that's the practical reason for Mission existing. But on a personal level, I do this for people like my mother. Uh, I was raised by a single mother. I have three or two other siblings. There were three of us. She started her own business. Anything she set her mind to, she accomplished. But the great equalizer still exists. No one can be everything to everyone. She didn't have a Mission Financial Planner. She didn't have someone helping her navigate the tax code, helping her think through a retirement plan, helping her structure plan. She did an incredible job. And I know each of you have too. But if there's something more you want to accomplish, if there's a goal you haven't quite mapped out, If there's a gap you know exists but haven't had time to address it, that's where we step in. I'm here to help people have more, whatever more means to you. More clarity, more confidence, more time, more options, more peace. That's our why. And that's exactly why we wrote the book, because over the years we realized something. Financial planning shouldn't feel scattered. It shouldn't be a bunch of disconnected advice, random accounts, or one off decisions. It should be proactive. It should be a framework. So we built one. The five pillars of financial planning: it's income, investments, insurance, tax planning, and estate planning. Income is the foundation. How is money coming in today and in retirement? Pensions, Social Security, rental income, business income. How does it all flow together? Investments support that income, not just growth for growth's sake, but positioned intentionally to create flexibility, protection, and opportunity. Insurance protects the plan because the fastest way to derail everything is an unexpected health event, long-term care need, disability, or premature death. Tax planning weaves through all of it. When you draw matters. How you claim your Social Security matters. And estate planning makes sure everything you've built transfers the way you want to the people you love in the most efficient way possible. And here's the thing: Social Security touches every single pillar. It affects your income stream, it impacts how much you need from your investments. It, it affects survivor benefits from your spouse. It plays into estate decisions and legacy planning. That changes everything too. It's not just a government check, it's a lever inside a much bigger plan. The book walks through this framework, not in theory, but in a way that helps you see the pieces connect. Because when the pieces connect, confidence follows. And that's when you get to sit down at the CEO's desks and say, I'm ready. And so tonight, we're going to be talking about Social Security, how it works, and everything else in between. And with that, pass it to Mr. Matt.
All right. Thank you, Ken, and thank you everyone for making time to join us tonight. We're going to go ahead. We're going to jump right into it. I'm going to share my screen here quick. All right. Savvy Social Security Planning for Women. So those of you who spoke with me before the workshop, I told you I've been teaching these classes for a long time, and I'm a certified financial planner, national Social Security advisor. And part of the reason I got into this, and into this specific type of training, was because I saw this huge confidence gap. So if you look at this, you'll see that the confidence of women heading into retirement versus men is much, much lower. Um, on the left there, you can see women about 58% are confident about retirement. Men, it's 71%. The greatest fears, believe it or not, are realistic fears. They are not overblown. It is not you being nervous. It is not you being overly cautious, anything like that. Because when you think about, will my assets last? What kind of income streams will be in? What's going to happen to my health? What if I have to take care of someone and I have to do so financially? Again, going back to health, losing your independence right down the line. And you can see these concerns, and you can see all the way across the board, with the exception of being laid off or not being afraid of any aspect of this or not being concerned about any aspect of this. Women have legitimate concerns. Legitimate concerns. So the challenge kind of goes back to what Ken said, and it's that our industry has not done a great job of reaching out to you directly. So that's why we do this presentation. That's why we send the mailers out, is because we do want to reach out to successful women to make sure you know you have a voice that is here to help you make an informed decision. So what are some of the realities you face as a woman? Well, the first thing is lower lifetime earnings. That comes from a variety of factors. One, and we'll just say it, age discrimination in the United States is a very real thing. So when you think about wages, right, it's men make more than women for doing the exact same type of work. It doesn't necessarily matter what the work is, but for whatever reason, women don't make as much. If by chance you had children and you took 6, 12, 9, whatever months off to help get that child going, to recover from childbirth and all those things, well, guess what? Yeah, you missed out on promotions and things like that while you were gone. That's just a very simplistic view of some of the issues that women face that men don't. Because you have lower lifetime earnings, that translates into lower pensions. And a big surprise, maybe not, but maybe it's a surprise to you. Social Security is just a pension. You contribute to it, your employer contributes to it, a third party, in this case, the federal government, does the math and says, okay, here's the amount that we're going to pay you based on what you put in. And then the other thing, women live longer than men. My guess would be more women than men got the healthier option tonight. We've all seen plenty of YouTube short videos of men doing stupid things, right? But ladies in general, you do take better care of yourselves than we do. And so combine those things, lower lifetime earnings, which translates to lower pension, you live longer. Yeah, you have a legitimate reason to be concerned. Now, we have some people who say, well, that just means I'm going to work more. I'm not trying to say that at all. If you do happen to work more and you have it really focused in terms of what you're trying to do, and you can do some of the things you see on this slide, it can have a huge positive effect on your plan. It's kind of boring, but well, to me it isn't. But Wade Pfau, PFAU, is an actuary that both Ken and I have done some training with over the years. And he studied this in depth, just what's the impact of 1 year of paying down debt, padding your savings. Of course, it's one less year you're retired. And then, of course, you're raising your Social Security, your pensions, and so on. What's the impact of all that? 1 year of doing those things is like adding 3 years onto the back of your retirement income plan. So if you do feel like you're going to work a few more years, or if retirement is 5 to 10 years out, start thinking about, hey, how can I do some of these things while I'm in the twilight of my career? Okay, so that's a long introduction. Let's jump into the value of Social Security. First thing I'll address up front, Social Security is going to be there. There's no politician in either party that is going to kill Social Security or be the person who's going to be responsible for killing Social Security or Medicare. It's going to be there. Could it be reduced? It could. My guess would be, and again, I've been studying this for a long time. I've been teaching this for a long time. I've sat on panels. I've talked to people in Congress about this. And essentially, what they have to do to fix the program is adjust how it gets funded. And that comes down to a couple basic things, such as how much income is really subject to payroll taxes. What is the payroll tax rate? Is full retirement age always going to be 67? Well, guess what? When my dad retired, when my mom retired, their full retirement age was 65. Could it go up a couple years, right? There's things they can do from a funding standpoint that will put the system back on really solid ground really quickly. It's just going to take some will in Congress. If you're very concerned about this, if you're worried about this is going to sound corny, but it's true. Take the time to write a handwritten letter, send it to your representative in Congress and both of your senators and tell them you want them to take this seriously and get this fixed. Those things do matter when they receive those. So you will not outlive your Social Security income. You'll see in today's presentation and in the Social Security analysis that we do with you that we use just a 2% cost of living adjustment. The average historically is closer to 3. We don't like to use 3 when we do presentations and so on because we want to be as conservative as we can in our assumptions. So we're going to show you 2% on this presentation and in the analysis. But when you transition into financial planning with us, where we're looking at income, investments, insurance, tax, and estate, all those things that Ken talked about and how they interact with each other, you're going to see we're going to use the more realistic assessment at that point. But we're being conservative for tonight. So this has been up for a while. You can see $2,000 today, just with 2% cost of living adjustments, 10, 20, 30 years. Hey, in 30 years, it's almost $1 million in lifetime benefits that you'll have received. And in 30 years, that $2,000 a month will grow up to about $3,600 a month. So 2% doesn't sound like a lot, but it does add up over time. We're going to touch on 4 key rules and strategies. You can see those on the screen there. One thing, and you're going to hear me say this a couple times tonight, one important thing to remember about Social Security is that you can only file for one benefit at a time. Okay, you can only receive one benefit at a time. If I have my own benefit and my spouse has their own benefit, guess what? I can either file on my own or as a spouse. I cannot get both benefits at the same time. The system does not work that way. Okay. So you see these different rules and strategies. The really important part of this, though, is in terms of understanding what you're eligible for, is first of all, just understanding some basic questions. One, do you qualify for benefits on your own work record? So in other words, you paid the payroll taxes for at least 10 years. Two, are you currently married? And if so, has your spouse started receiving their Social Security benefit? And three, what about prior marriages? But more importantly, how did they end? Was it the result of a divorce or did somebody pass away? The reason why is the rules for you are very different depending on whether that person died or depending on whether it was the result of a divorce. So again, you could be eligible for up to 4 benefits. Okay, retirement, spousal, divorce spouse, or a survivor benefit. But again, please remember, you can only take one benefit at a time. If I'm retired, I'm taking my own benefit. My spouse died. Does it make sense to look at my benefit and what the survivor benefit is to see if I could get a larger benefit? Yes, it does. But you won't get both. Okay, you'll get one or the other. Say it another way. If you're a married couple, when somebody dies, the smaller benefit will stop paying. So that Social Security income that you're used to seeing come in the home is going to be reduced. Okay, couple definitions for you. And this is the homework assignment I talked with a couple people about. Okay, first thing is just about everybody on today's call is born 1960 or later, but which means your full retirement age is age 67. So you remember the people I spoke with at any rate, I said, hey, for that Social Security analysis, we need to know, what does Social Security say they're going to pay you at 67? Okay, we don't need your Social Security number. We just need to know what do they say they're going to pay you. The amount they pay you at 67 is what's called your primary insurance amount. And this is a screenshot of what a statement looks like. Social Security no longer mails statements out. To get your statement, there's one of 2 ways to do it. One is, and this is what I would recommend, is create an online, create an account for yourself at the Social Security website, ssa.gov, log in, pull your most current statement. Also, look at your work record. Make sure it's accurate. If you have your tax records, look at what is in your tax records versus your work record. It's rare, but occasionally there's an issue, right? Something doesn't line up. If you can provide documentation, they will get it fixed. Okay. But for your analysis, and I know some of you are doing it as soon as tomorrow, for your analysis, we need to know current age. How old are you today? And what does Social Security say they're going to pay you when you turn 67? How do you get that number? Easiest way is go on the website, create a login, pull your statement. If you're not comfortable doing that, call them. You'll probably hold for 15 or 20 minutes. They'll confirm who you are over the phone, and then they'll be able to tell you what your benefit looks like. And what you're looking for is the retirement benefit. Okay, what's my retirement benefit? So ssa.gov is where you're going to find socialsecurity.gov/my account, but I would just go ssa.gov to find that. Okay, your retirement benefit really depends on when you file. It's really that simple. One of the questions I get quite frequently is, hey, if I file as a spouse or on my own, can I then file later on as a spouse maybe and get a bigger benefit? Partially. You're not going to get the full benefit, which you'll see in a minute. The key is your benefit depends on when you filed, okay, when you claimed it. If you file before full retirement age, you can file for an income benefit or a retirement benefit as early as age 62. But if you do, and you can see it in the middle of the screen, you're only going to get 70% of your total benefits. You're not going to get the whole thing. You can see it gradually goes up until you hit 67. That's when you get 100%. What if you apply after full retirement age? They'll give you an extra 8%, but there is no reason to wait past the age of 70. None whatsoever. And in fact, we had a client last year who forgot to file. She loved what she did. She worked right up through Christmas. She retired on Christmas Eve, got to spend the holidays doing what she wanted. And she said, she called me up. We had lunch in early January, and she said, I'm 71. And I'm like, you filed for Social Security, right? And she just looked at me and said, you know what? Last year, I totally forgot. So don't wait. Okay. Don't wait. Just make sure you file at 70. We can encourage you to do so, but at the end of the day, you're the boss. You're the one who has to actually go and do it. Um, you're going to see a lot of charts, not just from us, but other stuff you're going to read that says, oh, you should wait to get the biggest benefit possible. And is there some truth to that? Sure. I mean, like you'll hear me talk tonight about my family and my wife's family both have a lot of longevity. And my wife and I do a pretty good job of taking care of ourselves. So again, anything could happen. But if we live as long as some of our relatives have lived, um, we want to see, maybe some bigger benefits later on in life because, we have lots of longevity. As an example, my wife has a 95-year-old grandmother who's still driving. So, from a planning standpoint, if I delay benefits and I factor in the cost of living adjustment, yeah, on the lower right, you'll see you're getting about $3,000 a month if you started at 2000, waited 8 years, and then filed at 70. Well, the real impact of that is if you do have longevity, well, you get into your 90s and beyond, and you can see there is a huge difference between filing at 62 versus filing at 70. Don't worry about memorizing this stuff. Just remember the concept. Okay. The concept is very simple. It's if I take the benefit early, I minimize the impact of the cost of living adjustments. 2% on a smaller number is a smaller increase in terms of what hits your bank account. It's just the way it works. So if you can wait, if you can afford to wait, and you're concerned about longevity, you've got good health, you have other income sources, that's great. One of the other benefits of waiting until 70 is, and Ken hinted at this in his introduction, is you maximize the tax benefits of Social Security. California does not tax your Social Security benefits as income. It doesn't. So would I rather be getting at 95, call it $5,000 a month of income tax-free at the state level, or 2691 tax-free at the state level? I probably want the bigger number. The other thing is at the federal level, at least 15%, 15% of your Social Security income is tax exempt. Again, would I rather get 15% of a bigger number or a smaller number? Probably a bigger number. This goes into, and I've had a lot of people do this to me over the years they'll show up to their Social Security analysis, they'll have their spreadsheet, and they'll say, well, Matt, I did the break-even analysis, and I know I'm going to take it at 64 because I think I'm only going to live to 77. Okay, great. So a couple of issues with that. Number one, how do you know you're only going to live to 77? Number two, did you do a tax analysis? When I get to question two, in 15 years of teaching this class and doing Social Security analysis, I have never had anybody say, yes, I did a tax analysis. I've never had someone say that to me. So when you think about the planning for this, it's not just income, it's taxation, but then it's also the impact of a lower tax bill, higher Social Security on your portfolio, because now your portfolio does not have to generate as much post-tax income for you. So you want to think that through pretty carefully before you make this decision to file. Okay, so I touched on this. Just remember this. You file early, you've got a minimal benefit. It minimizes the impact of your cost of living adjustments. One other reason not to file early. If you're still working, you like what you do, and you're making over $24,480 this year, so not even $25,000 a year, they're going to withhold $1 in benefits for every $2 that you go over that amount. Well, the maximum benefit is about $4,000 a month. It's $48,000. So If they withhold $1 for every two that I go over that limit, 80,000, 85, $90,000, somewhere in there, they're just going to withhold your entire benefit. There's no reason to file early. The key is when you get to full retirement age, 67 for just about everybody on the call, once you get to 67, well, guess what? Now you can get your full Social Security and your full income. You can double dip. So from a planning standpoint, if you're feeling like you really love what you do, and or maybe you're one of those people that maybe is worried about retiring because you're not sure what you're going to do with those extra hours, right? Doesn't matter. If you're 67 or older and you're working and you want to file and take your Social Security, hey, you know what? Maybe that's the right thing to do. It might be. They're not going to do this to you. They're not going to withhold anything at that point. The other thing that they will do, though, is they'll recalculate your benefit every year. And what you'll most likely see is an increase in your benefit. The reason I bring that up is because they actually look at your best 35 years of income when they do the calculation. Well, if you're making mid six figures as a 67-year-old, and there just happens to be a year of income from when you were young, when you were flipping burgers for someone, well, guess what? That age 67 income could maybe replace that age 27 income. And now what you see is your benefit goes up because remember, they're looking at your best 35 years of income. So if you're going to file and you're still working, you're making more than, let's just say 80 or 90,000 a year, there's no point in filing early. They're just going to withhold the whole thing. Okay, I touched on spousal benefits earlier. Let's talk about how spousal benefits work. So you can see down at the bottom here, here's a perfect example of how this works. Spouse A, and it's one of the things I don't like about this slide. I don't like how it's written because ladies, there's a good number of you who made more money. You were the higher income earner. But let's just say spouse A is the higher income earner. That person's benefit is $2,400 a month. Spouse B didn't pay into the Social Security system, worked out of the home, whatever it might be. So spouse A files at full retirement age. That's the key. Files at full retirement age. They're getting their full benefit. They're $2,400 a month. Okay. Spouse B, when they turn full retirement age, if they file at that point, they will get 50% of spouse A's. Sorry, my headset turned off there. They will get 50% of spouse A's Social Security benefit. Okay. So if spouse A filed at 67, they're getting 2,400 a month. Spouse B waits till 67. They file as the spouse. Now they're getting 1,200 a month. Household income from Social Security is 3,600 a month in this example. Okay. Earlier, I touched on the idea that you could maybe file early and then try to switch to a benefit later on, but you won't get the full impact. This is what I'm talking about. Okay, there's a lot on this slide, but here's the key thing I want you to focus on. If you can see right here, I'm gonna use a laser pointer. Okay, right here. Here's 2,400. All right. Spouse B has 800. Spouse B files at 62. Remember, they get the 30% reduction. So they're not getting $800, they're getting $560. Okay. Spouse B waits till 67, or spouse A, the 2,400 person, waits till 67. They file, they're getting their 2,400 a month. Spouse B waits till 67, says, okay, now I'm going to file as the spouse. They don't get 50% of the 2,400. They get an extra $260, which means they're at 820. They're not at 1,200, they're at 820. Why? Right down here. You took a benefit at 62. Okay. That's how the system works. So if you file early, guess what's going to happen? That decision will track you. It will follow you. Okay. If you wait till full retirement age, you get your own benefit or 50% of your spouse's, whichever is bigger. They do not play shell games. They will just flat out tell you, oh, your benefit's bigger than your spouse benefit. Take your bigger benefit. That's what they'll do. Okay. All right. Here's an example of that. You can see in this case, spouse A gets 2,400 on their own record. Spouse B gets 2,000 on their own record. In this case, spouse B, you're not going to file as the spouse. You're just going to file on your own. You're going to get $2,000 a month. So pretty straightforward. All right, let's talk divorces. From a divorce standpoint, I'm going to tell you a funny story, and it pretty much covers everything on the slide. Um, this was about 10, maybe 12 years ago. I was asked by a friend up in Omaha, Nebraska, to come up and give this talk to a room full of their clients and prospects and so on. So I went up there and I did it. And it was a lot of fun. I'd never been in Omaha. I had spent some time in Nebraska when I was in the Army back in the 90s, but never made it to Omaha. And had a good time, gave the presentation. At the end of the presentation, this nice lady came up to me and she said, "Hey, can I ask you a question about the divorced benefit?" And I said, "Sure, go ahead." So her question basically came down to she had a friend who had three ex-husbands. And I was like, huh, okay. And she said, "Well, what should my friend do? I mean, she's got these three exes. How does she track this down?" And I said, "Well, did each marriage last at least 10 years?" She said, "Yes." "Is your friend currently married today?" She said, "No." "Are the ex-husbands all at least 62?" "Yeah." "And did the last or did the last divorce occur at least 2 years ago?" "It did, actually, about 3 or 4 years ago at this point." And I said, "Oh, okay." All she has to do is go ahead, call Social Security, be able to identify the exes. Okay. Social Security number, divorce decree doesn't hurt. They may want you to come down to the office. Okay. But identify the exes and ask them which one gives me the biggest spousal benefit while I'm alive, while he's alive, and then which one gives me the biggest survivor benefit once he's gone. And whoever that person is, that's the person she should file as the divorced spouse, and then once he passes, as the surviving divorced spouse. The reason the story is funny, she like nodded at me and said, "Okay, that's what I'm going to do." It was pretty funny. She was asking about herself. But those are the keys. 10 years, unmarried. If the ex is at least 62 and the divorce was more than 2 years ago, hey, guess what? That stuff I said about when you're married, you have to wait for your spouse to file for you to be able to get a spousal benefit. If you're divorced, it doesn't even matter if they've been married or if they have filed or not. Okay. Um, I'm not going to take you through this whole slide, but I want you to take a look at the bottom three bullet points. All right. So let me get the laser pointer back out right here. Okay. So in this case, the X filed. What happened? So you're the X. You filed for the spousal benefit. Okay. You filed for the survivor benefit. Doesn't matter. You filed for a benefit based on that X's work record. First thing is your X does not know because their benefit is not affected. If your ex has remarried, their spouse will not know because it doesn't affect them either. And if there are other exes out there who are getting a benefit, it doesn't affect them either. In fact, the only way your ex is going to find out is if you tell someone and then it gets back to them through the grapevine. So, from a planning standpoint, this is great because this actually does help to protect you quite a bit. Right, hold on a second here. My mouse is kind of freaking out on me. Okay. All right, we touched on this. All right, let's talk about what happens when the first person dies. Okay. It all hits you at once when that first spouse passes. And so the survivor benefit that gets left behind comes down to these two key points. When did the spouse originally file? Did they take it early? Did they take it at 67? Did they take it later? When did they take it? And then when you, as the survivor, when you file, that's part two. That's really important. So these two things are what drive the survivor benefit for you. So here we're going back to that $2,400 a month example. Okay. Let's say that this person with the 2,400, they waited all the way till 70. They got the delayed credits, they got all that stuff. So they're not getting 2,400, they're actually getting closer to 3,000. Okay. $3,000 a month. Well, guess what? What that person did, they set their spouse up so that once their spouse turns 67, they could claim that survivor benefit and get the full 29.76 a month. Full thing. If that person took it at 62, the most their spouse could ever get is 19.80 a month. Some of you have $4, $5, $6,000 a month Social Security benefits by the time you layer in things like delayed credits and all that stuff. I don't know about you, but I know a lot of people would prefer to get 100% of that than get 82% of that. Okay. Think about the tax advantages. Think about survivor income. Think about all those things. It does add up and it can have a pretty significant difference. Okay. So again, here's an example for you. You can see here, age 63, if you took it early, age 63 is when your spouse is capped for a survivor benefit. And in this case, the most the spouse could ever get is 19.80 a month. If you wait, 29.76. Okay, 29.76. All right. Let's see if I can get out of my laser pointer. Yes, I can't. Okay, I'll have to deal with that after the workshop. There we go. Okay, how soon can you take a survivor benefit? You can take it as soon as age 60. Um, the if you're married, right, and you're both, you're already 60 years old, you can file right away. People ask me, well, what happens if he died at 65? Social Security will assume he was going to wait till 67 if he had not filed. Okay. What if he dies at 68 because he was planning on waiting until 70? Well, anything past full retirement age, you're going to use the age you were when you passed away. Okay, so up to full retirement age, up to age 67, they'll assume that you were waiting for 67 if you died without a benefit. If you were 68 or 69, they're going to use your actual date, your actual age you were when you passed away. And then the last bullet point here, you have to be married 9 months unless it was an accident. Okay. This slide, again, there's a lot on this slide. If you want to go back on the YouTube channel and pause this and take a closer look at it, please feel free to go through those numbers. The biggest thing I want you to take out of this concept here is this is a household that has about $4,200 a month of Social Security. Okay, about $3,000 through the person who had the bigger income, about $1,200 through a spousal benefit. Well, what ends up happening when that first person passes is income is going to drop because I mentioned it before, I'll say it again. The smaller benefit stops paying out, which means instead of 41.76 a month, now they're down to 29.76 a month. And the real kicker to this for the surviving spouse is, guess what? You're going to go from those, once the dust has settled, you're going to go from those married filing joint brackets to the single brackets. Your Medicare premiums are probably going to go up because of the way they do the means testing for Medicare. And a lot of people think, oh, well, when my spouse dies, my expenses will drop significantly. In most cases, they don't. At the most, they drop by 15%. It's pretty minimal how income needs really change once somebody passes away. So this can matter, right? It can matter. And again, that's why it's so important to do this as part of an overall plan, as opposed to just making this decision in a bubble and not thinking about some of the other things we've talked about tonight. Okay. Divorces work the same way. Marriage lasted at least 10 years, currently unmarried, or here's a wrinkle for you. Let's say you get remarried after the age of 60. Well, guess what? That high income earning spouse who their job was more important to them than you, guess what? You get married after the age of 60, you could actually use that person's survivor benefit. Key is don't get remarried before 60. Get remarried before 60, you're with whomever you're with. Okay. That's just the way it works. So if one of you has longevity, in many cases, it does make sense for the person with the bigger benefit to wait the longest to take. Now, what would the longest mean? It could mean 67, could mean 70, could mean 65, right? Again, every situation's different. But the person with the bigger benefit, that's usually the person who is encouraged to wait. Okay. When your spouse passes, you have the ability to take your own benefit and then switch to a bigger benefit later on without a penalty. Okay, this is only in the case that your spouse passed away. Okay, it's not for just filing as a spouse or a divorce or something like that. So here's an example. You can see here we got Linda at $1,000 a month. Her spouse had a $2,200 a month benefit and passed away. So what Linda could do, I mean, if this made sense for her, is take her benefit at 62. She'll get the reduction, right? She doesn't get 1,000 a month, she gets $700 a month. But then once she gets to full retirement age, which is when her survivor benefit is as big as it's ever going to get, she could switch over to that big survivor benefit. So don't forget though, remember a few slides ago, I talked about withholding and Social Security. From a withholding standpoint, what we're concerned about there is, well, guess what? Your income's above certain levels, that dollar in benefits withheld for every $2 that you go over, it's going to apply. It even applies to survivor benefits. Don't forget that doesn't go away till you turn 67. Here's a different example. You got Dora. She's getting $2,000 a month. Her spouse passed, and her spouse's survivor benefit is $1,800 a month. Well, what could she do? Well, you can actually take a survivor benefit as early as 60. So she could take it at 60, take a reduction on it, get about $1,300 a month, let her own benefit grow all the way up to 70, and then get that much larger benefit for herself. So if somebody passes in your 60s, you're in your 60s, you've got some options in terms of what might make the best sense for you. Okay, remarriage. Don't forget, remarriage at any age, you are hitched to your new spouse. If you get remarried before the age of 60, that applies all the way across the board. If you get remarried after the age of 60, it does not affect the survivor benefits. That high income earning spouse whose job was more important than you can take advantage of it if you get remarried after the age of 60. So this gets kind of back into what I talked about with the person with the bigger benefit needs to be the person to wait. Whoever has the bigger benefit. It's not just about income for you while you're alive, it's income for your spouse once you're gone. Think about what I talked about earlier. What are the tax implications? What's the income plan implication? What does that mean for your investment management? What does that mean from an estate planning perspective? These are all those 5 pillars that Ken talked about in his introduction. That's why we want to take a thoughtful look at them. I know from years of doing this, most of you have an advisor that you're very happy with. And the only thing that advisor does is manage your IRA. I know that for a fact. They're not looking at taxes. They're not looking at serious income planning. They're saying, oh, you don't need Social Security. You'll be good. They're not looking at how this should maybe inform modifications, changes to your investment management plan. And they're certainly not thinking about estate planning. What are the considerations? Have you had an in-depth discussion about how all this comes together? So the biggest thing, compare your benefit, take the biggest benefit last, and don't get remarried before the age of 60. We're in the home stretch here. We're going to wrap up in a few minutes, but a couple things I want to really hit on tonight. If you are married, every now and then we'll meet someone where spouse A is doing their own thing and spouse B is doing something else. You guys got to talk. You got to talk about this stuff because a decision you're making might have an impact on them. It's a real impact, right? We just want to make sure you're having the conversation. If you're divorced, if you're considering a divorce, you need to talk with Ken. Okay, you must have a conversation with Ken if you are divorced or you are considering a divorce. Ken is certified in financial analytics for divorce proceedings. He can advise your attorney if you're going through that process. But the key with the divorce is if you're entitled, make sure you understand what's available to you. My mother-in-law went through this. She was married for 20 plus years. They got a divorce. You know, years later, I come into the picture and get married to her daughter. And she finds out I do this for a living. And as she gets to retirement age, she asked me if I'd be willing to, you know, talk her through Social Security. And I said, okay, great. First thing you got to do is you got to go down or call Social Security and ask them, what am I entitled to based on my ex's work record? Just like I said to the lady in Omaha, right? What are you entitled to? So she goes down to the Social Security office in Michigan, which is where she lives, and they say, you're not entitled to anything. Okay. She tells me this. I tell her, go ahead and call them, call Social Security. So she calls, she gets someone on the phone, they tell her the same thing. So she comes down to San Antonio to visit us and the grandkids. And I'm like, you know what? Let's go to the Social Security office together. Let's get this straightened out. So we go down there, and the young lady behind the bulletproof glass is very polite, very professional. But she says, I'm sorry, ma'am, you're just not eligible for anything. And I look at the young lady and I say, well, unless the rules have changed. I don't think that's accurate. Is there any chance we could talk to a supervisor? She said, yeah, just give me a minute. So she goes in back, and it's about 2 minutes. And ladies, I can tell you, and maybe you've experienced this with a son-in-law at some point, where you think he's kind of a moron. Because I can promise you, in that moment, my mother-in-law, and I could see it, right? I looked straight ahead. I didn't look at her. I could just see it. She was looking at me, and she was thinking, oh my God, my daughter married an idiot. I could just see it. Well, the supervisor comes out, and he had two sheets of paper with him. He had yellow highlighter on both. And he just said, I am sorry, ma'am. Yes, we almost gave you the incorrect information. Here's what you're eligible for while your ex is alive, and then here's what you'll be eligible for once he passes away. She said, thank you. So if you're divorced, the reason I'm telling you that story, make sure you understand what's available to you. Make sure. We talked about if you're a widow or a widower, make sure you understand your benefit versus the survivor benefit and what might make sense for you. We do get a fair number of single people who go through this training with us. And I used to hear things like, well, this doesn't really apply to me. And, you know, I strongly disagree with that assessment. And the reason why is everything we talked about tonight applies to the single person as well. It's just there isn't this other party, this other spouse, this other person in the mix that makes them think, what do I got to do from a survivor benefit, or what do I got to do from a spousal benefit standpoint? Do I take Social Security early? Do I take it later? What are the tax implications? What does that mean in terms of my investment management? What does that mean in terms of my overall income plan? If I have estate planning goals of any kind, what if I have estate planning goals of any kind, what does that mean? These all apply to the single person every bit as much as they do to married couples or people who have a spouse who passed or went through a divorce. And then the last thing, don't forget, if your spouse did pass away, you can take a spousal benefit as early as age 60. Just please remember there's the withholding that happens. So if you've got 80, 90, $100,000 a year of earned income, you know, you're still going to face that withholding. Okay, what does a prudent person do? A prudent person would plan for the extra long life. If your family lives into their 70s, you need to plan for 80s. If your family lives into their 80s, you need to plan for 90s. And if your family lives into their 90s, you need to plan to be a centenarian. You just do. That was a real eye-opening experience for me about 3 years ago. I was working at a convention with a 401k company that we partner with occasionally. And their representative and I were talking, getting to know each other at the booth and all that. And we got talking about longevity. And I told her, my family's longevity. And she just looked at me and she's like, you need to plan to live to be 105. And I was like, okay, she's right. I do. Because my mother's dad made it to 97. He ran the family farm until he was 92. At 92, he couldn't climb up the back of a tractor anymore. So he gave up the physical requirements, but he kept running the books and records, the business side of the farm, right up until the day he died. My dad is going to be 88 this summer. My mom is 83. Already talked about how long her dad lived, but I was looking today. Her grandfather died in 1976 when I was all of 3 years old. Well, he was born in 1889. He made it to 87 years old. So I'm looking at this male longevity going, oh my God. And I already told you about my wife's longevity and her family. Yeah, we need to plan for this. Part of the reason why, take advantage of the inflation adjustment because those decisions we make early on, as we all know, did I start saving in my 20s and 30s? Did I get insurance before I got sick or the unexpected happened? Did I stick to my diversification and asset allocation in my investment strategy and not panic every time the market went down, right? Or panic when we saw a lot of volatility? Did I stick with it, right? Those decisions have huge, huge ripple effects on what's going to be possible later on in life. We've talked about this a lot. Delaying does give you higher income, but please remember it's got to make sense in terms of what you want to see happen. And coordinating can give you some extra money as well. But if I haven't said it enough, okay, Social Security is a foundational part of an income plan. The key word there is part of an income plan. For some of you, the biggest Social Security check is only going to be 10 or 15% of your income in retirement. It's still 10 or 15%, and you still want to make a good decision about it. So it's something that will have an impact. Just make sure you do what's right for you. Get some advice. And if your existing advisor is not doing that, let's take that Social Security analysis. And then step two for us is to say, okay, let's look at the bigger picture in step two. But at a minimum, everyone who is here tonight will get the Social Security analysis. We will take you through that process. Remember, all you need to do, this is your homework assignment. All you need to do is come to that meeting. You got to know how old you are. And number two, what does Social Security say they're going to pay you when you turn 67? If you don't know, the easiest way is to go to ssa.gov, create an account, pull your statement. It's the easiest way to do it. If you want to call them, feel free to call them. You can do that too. You'll spend 15, 20 minutes on hold. But thank you so much for your time tonight. I know we had one or two issues with meals tonight. Um, hopefully we've got everything all taken care of in terms of meals. I see Ken, thank you so much for taking the time to monitor the chat and all that. But otherwise, I will go ahead and hit stop recording and we'll keep the room open for a few more minutes just in case there's any questions.